Okay, so today we're going to be talking about accounting for not-for-profit organizations. And some of you might wonder, how does this all come into study of governmental accounting? Notice how these two topics are placed together, governmental accounting, bless you, and not-for-profit accounting. Well, I guess one of the reasons is that in most areas, some of the things that we learn in the not-for-profit area are quite similar actually to the governmental area. And you also know that the not-for-profit plus the governmental section makes 25% of the CPA exam. So if this might make the difference between passing the CPA exam and not passing the CPA exam, because these two sections make up 25% of the exam. Okay. So let's talk about some of the similarities, and I know I always start off my lectures by telling you how simple things are until you realize they're not. But this really isn't complicated, because not-for-profit accounting is really accrual-based. It's there are a lot of things which mimic business type of for-profit organizations, but there are some things which are different. And what I'm going to do is I can probably tell you everything about this topic in 5 minutes. We're going to take 2 lectures. But what you'll find out is, first of all, you need to understand what we mean by not-for-profit. So what does it mean, a not-for-profit organization? Yes. Well, that's good, but what do they do? What do they do? Yeah, Kyle. Yeah, well, so one of the things is the activity that's being conducted is not being done for profit, right? Another distinguishing feature is what? They, yeah, that's right, grants and contributions, where people don't really expect to get back what they, it's a contribution itself. Yeah, okay. But those are some of the things that come to mind when we think about not-for-profit organizations. So what we're going to do today is talk about, first of all, the nature of not-for-profit, figure out the difference between them and governmental not-for-profit, then talk about how we recognize their revenues, how we recognize their expenses, how do we recognize their assets, and the equity section, how it looks different from the rest. That's it for the agenda for today. Those are the 5 items that we have. And so this is what I just talked to you about, distinguish the not-for-profit organizations from other entities in the governmental and commercial sector. And some of you might think you know the differences already, right? What is one of the distinguishing features of government? They do what? They have the power to do what? Tax, right? Not-for-profits don't do that, right? Standard setting bodies. If it's a governmental not-for-profit, where does it look for GAAP? GASB. If it's a non-governmental, where does it look for? FASB, okay? And then we'll look at some of the statements. And we'll look at the 3 required statements plus 1 other statement which is required for voluntary health and welfare organization. So that's kind of our agenda for today. And then there are some small miscellaneous topics on combination, consolidations, and fund accounting. So let's start off with, so you've taken the tax course, right? So what are not-for-profits required to do every year if they have more than $5,000 worth of revenues? They're required to file what? Something with the Internal Revenue Service, right? This Form 990, which we'll talk about next in the next class. But what we want to do is we want to understand that the not-for-profit sector comprises a very major portion of the economy itself. When you look at some of the large charities, you're talking about some big dollars, okay? And what you'll notice is that most nonprofits are not governmental in nature. They're not governmental in nature. There might be a government museum here or there, but most of them are not. Some of them are, owned and operated by government, but most of them are not. And as you said earlier, they are philanthropic and they rely on contributions and services of volunteers. And this is, from an accounting point of view, this is what we want to learn. How do we recognize contribution and services? Okay? So for instance, I might give you an example and say to you, and we're kind of jumping ahead. If you as an accountant performed a service, so you spend 3 hours doing the tax return for the nonprofit, and you spend 2 hours in selling tickets to an event, there's a difference in the voluntary service that you're providing. And these are the distinguishing things we're going to figure out, that not all services are the same, okay? And as I said, how does a non-governmental not-for-profit differ from a business entity? Well, we know that. Most of these are non-exchange transactions, and the purpose is other than to earn a profit for owner. Everybody remember the definition of exchange and non-exchange transactions? Exchange transaction, what happens? Equal value or near equal value changes hand. I give you something, and what does the other entity provide? Give you something in return, right? And this is where things become a little tricky. You ever hear about you pay the membership dues to an organization and they give you something back in return, which is of value? So part of it is value and the other is what? Contribution. So we'll talk about that. And lack of defined ownership. Apparently, we don't have shareholders, so there is that. You can't sell it. You can't transfer ownership in that way. How does a non-governmental not-for-profit differ from a governmental entity? Again, quite obvious. One of the things is it may not have the power to issue tax-exempt debt. Okay? These are the things that distinguish a governmental from a non-governmental. And we talked about these 3 things anyway earlier in our course. So if you wanted to find out the difference or find out if it were a governmental or a non-governmental, these are the 3 questions you'd ask. And again, the discussion on FASB versus GASB. If it's a non-governmental, it follows FASB. If it's governmental, it follows GASB. And specifically this ASC section 958, you'll see that mentioned in the book quite a bit. Okay, so financial statements of for not-for-profits, we'll take a look at some of these, okay? And first we'll take a look at the statement of, so the first 3 statements are required statements, and this only applies to voluntary health and welfare organizations. So let's take a look at the first statement, which is the statement of financial position. I can show you, see some of you don't have the book, but let me see if there is I can show you an example of this. Just actually, the statement's very similar to the other statements. Let me just give you the differences with a not-for-profit. See this? Unrestricted, temporarily restricted, permanently restricted. This is like the bread and butter of not-for-profit. You need to understand these 3 terms. Okay. So I give you a contribution, Jing Jing. No conditions attached. I say, here's my $1,000 check. Do what you want to do for your organization. What is that? An unrestricted contribution, right? Now I come in and give you a $1,000 check and say, you know what? You can only use it for this purpose. What do you think that becomes then? Temporarily restricted until you use it for that purpose, right? And then it becomes what? Unrestricted, right? I give you a check for $1,000 and tell you you can only use it next year. Or you need to do it. Ever hear NPR, 50% match? You know, give us money now, and there's somebody who's going to match 50%. That's what a conditional match, right? A conditional pledge. So temporarily restricted are items which wait for something to occur to become unrestricted. And what are permanently restricted? I give you $10,000 and say, you know what, you can only use the earnings. It's like the permanent fund, the endowment. So what we have in the financial statements, and just visualize this, every activity is broken down into these three categories, okay? So, for instance, and I'm going to just exit out of this for a quick second. So, any questions, by the way? I'm just trying to get to the textbook, so no, it won't give the password. Hopefully. Okay. One good thing about being an instructor is you have access to a lot of books, electronic books. Okay. All right. I just wanted to show you this so you can see how it's actually used. All right. So take a look at this. This is the statement of activities. Notice how it's organized. Unrestricted, temporarily restricted, and permanently restricted. Notice how it works. And look at this. This one line, net assets released from restriction. These assets get from temporarily restricted to unrestricted. Notice that difference? And look at how the statement is organized. This is easy on the left. You see the revenues minus the expense. But look at how we keep track. It's like three different funds, right? This is very much like fund accounting. You see unrestricted, you see temporarily restricted, and you see permanently restricted on a comparative basis. Okay. Everybody see that? And in fact, when you look at the balance sheet, look at the balance sheet. Look at net assets being again split into three categories for not-for-profits. Unrestricted, temporarily restricted, and permanently restricted. Okay, so it's really nothing more than that by itself. Okay. All right, so let's go back to our this was the statement of activities. And a couple of things. When you look at revenues, you have to be careful with how you use the terminology. And I know most of us won't think of it this way, but revenue, the word revenue for a nonprofit means an exchange transaction. Revenues, gains, and contribution, which are what? Non-exchange transactions. Okay? So you have three categories of inflows. You have revenues, you have gains. You might say, what are gains? Well, gains on investments or sale of assets, whatever that might be. And then you have contributions, which are what? non-exchange transaction. Okay, so you will see that shown on that statement itself. And again, we use a full accrual basis. Okay, and obviously all expenses decrease unrestricted net asset. So it really is not complicated in any way. You have 3 buckets, and from each bucket you derive revenues and you charge expenses. And basically what happens is, instead of charging the expenses to each bucket, they get transferred, released to the unrestricted where the expense is actually recorded. Okay. And as it says, FASB allows flexibility in presenting this information. Some people use operating and non-operating as categories, but this part here, expenses are reported on the face or on the notes by functional categories, is really important. Why is this important, by the way? Why is this important for charities? Yes, Doug? Okay, let me ask you this question. You give money to a charity. What's that website? Charity Network? There's a website which rates all the charities. and something, charity. But let's say if you give money to a charity and they spend 50% on programming and 50% on support, what does that tell you? Remember, that's what before people give money to charity, what do? They look at what? How much money is being spent for the purpose of the charity? How much is spent on fundraising, right? How much is spent on administrative costs, right? And you have to keep that in mind, because I think the average is 75% of it should be used for programming. That's the average. 10% is used for administrative expenses. 7% I think is used for fundraising. And there's another category I'm missing. What am I missing? Fundraising, advertising. Advertising maybe, that's another. But 75% of it should be used, for the purpose. And that's why they're asked to show their financial statements in this format, because this way you can determine if they are using the funds the way you think they should be. Okay? Statement of cash flows, we're back to the FASB method of preparing cash flows, which is using the indirect method and not the direct method. Okay? You have one less category. And interestingly, on the statement of cash flow, look at the first part. It says unrestricted contribution and gifts are reported as part of operating activity. But look at the next line. Restricted contributions given for long-term purposes are included with financing activities. It goes to two different categories depending on the type of contribution you're receiving. So that's an important fact to keep in mind. Okay. And non-cash gifts or in-kind contribution are disclosed as non-cash investing and financing activities. Again, there's a cash flow statement here. Okay, now let's go to the statement of functional expense. And this is, I keep on coming to this because this is an important piece to the and this is on page 549. And let me go back to our okay, I want you to just take a look at this for a minute. Just see how it's organized. The statement is called Consolidated Statement of Functional Expenses. What did we look at so far? Statement of net assets or position, balance sheet. Then we looked at what? The statement of activity. Then we looked at what? statement of cash flow, and now we have this called the statement of functional expense. Notice how this is organized: programming activities and support services, comparative basis. So this way you know what each of these activities cost us. And this is for the American Diabetes Association. So what does this mean? What it means is that all your costs need to be allocated or put into this bucket. I thought there was a little, actually it's going to be coming up soon. There's a nice chart which explains this here. Look at this. We take the natural expenses and allocate them to one of these items, functional or support. Any questions, by the way, on this? Okay, let's talk about now the revenues, accounting for revenues. So what can a charity receive? Let's go back again. What do they get? Where do they get? How do they raise money? Contributions, right? What else? All these other examples, right? Investment income. What if they received a grant from the federal government for $500,000? What do you think happens? They are subjected to single audit. Doesn't matter that they are a nonprofit. If they receive $500,000, you need to do a GAGAS audit on it, right? So these are the types of revenues. So what you need to do is you need to differentiate between exchange transactions and non-exchange transactions. Exchange transactions are always unrestricted. They're always unrestricted. And non-exchange transactions are your support and contribution revenues. Let's take a look at the support category, which is the largest amount. These are classified as non-exchange transactions, are made up of contribution and pledges. You've probably seen the word pledges, right? What is that? A promise to pay. Does everyone come through? No. So it looks like you have to have like a provision for doubtful accounts for pledges, right? And it does happen. Are all the pledges received right away? Actually, this is a good example. You know Larry Ellison of Oracle? He promised Harvard University many years ago $115 million. Well, he didn't like what was happening to Harvard, at Harvard, especially with the president. So he revoked his pledge. Think about the accounting there, right? Now I'll give you another example. Are the A&P grocery stores still around? Okay. So the family that founded A&P, Robertson family, gave Princeton University $600 million towards preparing students for a career in government. Well, Princeton received $600 million and they decided to use it for everything else. So the family sued Princeton University for breaking the condition that was assigned to that contribution. Well, apparently it was somehow settled out of court, but that made a very big case. Then there was another one where some person actually pledged, it was about $10 million to the University of Texas. And after they got the money, he sued them to recover it back for some reason. So what I'm saying to you is the reason I'm giving you these examples is these are extreme examples because you need to know how to record pledges. and we'll talk about how you record pledge revenue. Okay? It could be a simple pledge where here's my $100 check, or it could be a pledge which is conditional based on when you will receive it and for what purpose you can use it. Okay? So apparently support increases unrestricted net assets, and this is what I was telling you about. When the donor imposes restriction as to purpose or how the assets are to be used, it goes into the temporarily restricted, and when the donor says that you cannot use it except for the income from that asset, then it must be held in the permanently restricted net asset. Okay, so you see the differences between the three. Unconditional pledge, you record these as soon as the support is made. As soon as you get the check, you record it. Conditional pledge depend on the occurrence of a specified future and uncertain event. Do not record these as support until the conditions are substantially met. Remember our grants, it's like just a little like that. You don't record it till the condition has been met. If it's unrestricted, you record it right away. Okay? And unconditional pledges received in less than a year can be reported at net realizable value, or whatever that amount is at the beginning. Long-term pledges are recorded at fair value. Okay? And this very last item, I want you to just pay attention to. Does anyone understand what this means? Difference between the pledge amount and the fair value is recorded as a discount and is amortized as the pledge is received. Can anyone give me an example of what that means? Eric? Okay. How about if I gave you, how about if somebody promised a pledge and said, you know what, I'm going to give you a certain amount each year in the future, 3 or 4 or 5 years from now. What is required is that you must discount for the cost of money that pledge, because the amount that you're going to receive years from now is not equal to the amount that you'd receive today if you had received it. That's what that discount means. Okay. And let's take a look at how this is actually shown. A charity receives pledge of $1,000 to be paid within the next year. It also receives pledge of $5,000 to be collected 2 and 3 years from now. Look at the journal entry to record this. Contribution receivable, you set up an AR, 6,000. Contribution temporarily restricted, 5,760, and you might wonder, how does that amount come up with? 4,760 plus $1,000 gives you 5,760. Then you might wonder, how did they come up with 4,760? That number was discounted. The 5,000 was discounted using present value number based on their investment rate, 3, 4, 5%. So that $5,000 being collected in years 2 and 3 from now is equal to 4,760. 240 is the discount. What do you do with this account anyway? This is easy, right? This is your revenue, right? What do you do with this? You amortize it over the life of the pledge. So what happens is you debit this account now, and each year you amortize what? A portion of it to revenue. That's what happens here. Does everyone understand this? So you're setting up a receivable, and you're setting up the revenue account for temporarily restricted, and you're setting up a discount account for it. Donated materials should be recorded as contribution and as expense at fair value on the date of the gift. Very interesting way to record items that you donate. to the Goodwill or somewhere else. Remember, you get your little receipt for your tax deduction, okay? So what do? You record it as a contribution, but at the same time you debit an expense because you are not getting cash. This is a fun thing. Services, how should they be recorded? So you go out and volunteer somewhere. How should the charity value your service? And I want you to think about certain cases. So you are a plumber or a carpenter, tradesperson, and you go out and do some work on a building of the charity. What should the charity do? Should they just say, well, service was free, we don't need to do anything on the accounting records? Answer one. Answer two, well, it was a contribution, and we have to figure out what a carpenter should be paid per hour. So recognize that as a contribution and capitalize it as part of the building by debiting the asset and crediting what? This contribution account. Or three, so that's the second option. Or the third option is to say, you know what? It's a contribution, but it's an expense. What do you think the answer would be? If it's a carpenter, should I, like donated materials, should I expense this carpenter's services, or plumbers, or electrician, or architect's services? Actually, I capitalize it. So if you had an architect spend 5 hours on your charity, 3 hours on doing your plans, and 2 hours on selling tickets, you capitalize what? The 3 hours, and the 2 hours don't mean anything. Do you see the difference? And that's what this is. Create or enhance a non-financial asset such as this, constructing a building, possessing specialized skills such as a nurse, would need to be purchased if not provided by donation, accountants and others. And we'll take a look at this. Actually, there is a let's take a look at this, see if you understand this. This is a question from the book. See if you can figure this out. Can you read this? Donated service. Indicate whether each of the following donated services situation would require a general entry for contribution revenue and a related expense or asset. Volunteer worked as sales assistant in a not-for-profit snack shop. Yes or no? What? How many? Who says yes? Who says no? Okay, it is right. Yep, absolutely, that's no. Why? Because sales assistant, does it require specialized skills? Some people might say yes, but how about the second question? Yes or no from this side? Good. All right. That is yes, because you are, it's an architect, right? What about number 3? Yes or no? Should it be recognized as a contribution revenue or not? Think about those two tests. Specialized skill, right? Now some of you might think Doug's shaking his head no, and it is right. It's not so, okay? We don't have that, okay? Let's go to the next one. Several local persons use their cars to deliver meals to senior citizens for Meals on Wheels. What do you think? Yes or no? No. Number 5, a psychiatrist volunteered several hours each week. What do you think? Yes. Number 6, local CPA firm Definitely yes. Right? Number 7. Okay, no. And that's no. And number 8, Ron. Yes or no? Absolutely, yes. Okay. So do you see the distinction? Okay, you got it, right? This is one of the important things you should be aware of. Okay. And how do you record it? Don't forget how we record it. Because we are not getting cash, you have to debit an asset or an expense account, and then you credit a contribution account. That's how you record this. Okay. Okay. And here we go. This shows you the entry. As you can see, one is being capitalized and the other one is being recorded as an expense. Now, special events. I'm sure you ever go to those beefsteak dinners where you eat like those are what? Your special events, right, that are held. And the question is, how do you show the revenue and expense of special events? Very simple guidance. Don't net the number. Show it in the gross amount. Gross revenues minus expenses. Okay? And let's see if there's an example of that. Hold on a second. Let me just see. There was a. Yep, it's 554. Okay, so this is how it's shown for the special event. You show the contribution, and you show the direct cost, and you show the net. But you don't net the number in the books. You show it separately. Okay. And hopefully the revenues will exceed the expenses. And this is what I was saying, that you should show the number. By the way, how do you account for fundraising expenses for the special event? Do you show that as a cost? This is a tough question, by the way. You know, the fundraising or the advertising and all of that for the special event. Do you show that as part of the cost of the special event? You might think yes, but the answer is no. It seems that it should be yes, but it's no. Now there is a whole discussion on this, and really this piece by itself, intermediary, it's just made out to be a major topic when it really isn't. All it talks about is what happens when one charity passes funds through another charity to its ultimate purpose. Okay, that's what the intermediary is. Transfer between a donor and a beneficiary. So somebody gives a charity something which then passes it on to another charity for the eventual disbursement. Okay? And the question is, and why is this question important? All right, so if you were the charity getting money from the top layer so you can give it to the other, do you recognize that as revenue or not? And the answer here is they need to show that just like your agency fund. You have an asset and you have a liability to whoever is going to receive those funds, except in the following case. If there is an exception occurs, if one of the following situation exists. There's this fancy term variance power, which allows it to direct the assets to another beneficiary, and the intermediary is financially interrelated. All very complicated to explain very simple things. You are a charity that receives money from another charity to be given to someone. If the charity giving you the money has control over what you do, or can direct you to spend the money they want you to do, then it should be recognized as revenue and not as an asset, as a liability. So that's where this means. Okay, so if you have control over the other charity, then you need to, that other charity has to recognize that as a revenue and as an expense when it makes. Okay, let's talk about expenses. All the expenses are recognized on the accrual basis of accounting. There is no modified accrual basis. And notice the word, all expenses are reported as decreases in unrestricted net assets. Remember when we spent money from temporarily restricted, what did we do? We transferred it from temporarily restricted to unrestricted. And this is what you need to understand. And it can get really complicated for some people. But remember how in governmental accounting we record a transaction two different ways? Well, in some ways, in charities, for temporarily restricted or permanently restricted, you need to do two transactions. If you spend any money from temporarily restricted assets, you need to do what? First, release that money from temporary to where? Unrestricted, and then to spend the money. So there are two journal entries involved for that reason. Okay. And you record depreciation expense for all capital assets except collections. Okay, now this is another interesting thing. This might seem to a lot of you as really boring, but it's an interesting thing. And an interesting question because the accountants do play a role here. How many times do you get a message from a charity which combines education with a plea for contribution? Remember, you get something from a charity saying, do all of these things. These are education, you know, this is what you should be doing, you know, write to your whatever, and, you know, and then at the same time, please contribute to our cause. Join costs with a fundraising appeal. Now, why is this an important question? The reason is it's an important question because you need to figure out, is it part of the programming cost or is it part of the support cost? If you've got an expense which has part of fundraising and part of programming, how do you figure out which one it is? So what we have come up with is this criteria which says of purpose, audience, and content. And basically what it says is that if your message is very clear, bless you, as to what the purpose is of your message, your audience is targeted, and your content requires them to act in a certain way, you can allocate the cost between fundraising and programming. Most of us would think that's obvious, right? That if it's doing two things, you should allocate fundraising and programming. But FASB says that if any one of these items, conditions are not met, it has to be classified as fundraising. You cannot allocate it. Why do they do that? Very simple. Because what would you do if you were the CFO of a charity? You want as many expenses shown under where? Programming, right? Whatever you're supposed to do. So what do? Everything that you send out, fundraising, you combine what? Programming, and now what do? You classify it as programming cost. And that's the reason why this rule exists, okay? Investments, nothing really terribly new here. Whenever a charity receives investments, they should be always valued at what? Fair market value. What do you need to do each year? Recognize either a unrealized gain or loss. If you sold the investment, then you need to show the realized gain or loss itself. Okay. Notice one thing, NFPs are not required to classify investments into trading, available for sale and held to maturity like commercial organizations. Okay. And obviously there are extensive disclosures. Collection items. This is very similar to what we had learned earlier, which is what do? So you are the American Museum of Natural History, a not-for-profit organization, or the Metropolitan Museum of Art. You've got all these paintings, all these specimens. Question is, do I capitalize them or don't I capitalize them? Could you imagine capitalizing the paintings at the Metropolitan Museum of Art, where each painting is worth $100 million or more? You know, some of the, some of their more valuable collection. What do? Well, you have been given the option to capitalize or not capitalize. And most folks do not capitalize. However, you can only choose not to capitalize if you do certain things, okay? And let me show you what they are. If they're held for public exhibition, protected, kept unencumbered, proceeds from sale of collection, items are to be used to acquire other items for the collection. And there is actually a footnote on page 559 this footnote here, I want you to just read the last two paragraphs. The collection are the property of the museum and are not recognized as assets in the statement. They are held under the care of, the staff for scientific research. So the museum collection policy requires that the proceeds from the sale of collection be used to purchase other collection items. See how that works? So this is from their footnote. And this is interesting because just think about it. If you don't capitalize assets, so let's say if the Metropolitan Museum of Art received a painting from someone worth $100 million. Question, should they recognize that as revenue if they don't capitalize? No, what do? What account are you going to debit? If you don't capitalize it as an asset, you have nothing to debit. So there is nothing to capitalize. Okay. Buying, no. Because just think about it. If they did that, if they capitalized it, then they can sell it and show that as revenue and then what? pay their employees. When that day comes, they're really in trouble, right? Because that's all they need to do is just sell one painting every year. And they don't have to worry about anything, right? Just sell one painting every year, and they don't have to be concerned about raising money at all. But in that case, they'd have to, as you said, Andrew, they'd have to capitalize the assets. Okay. And then it talks about consolidation and mergers. You can read about this on your own. This is what happens when one NFP combines with another. If it's consolidation, anyone remember your financial accounting? What method do you use for consolidation? The equity method, right? For consolidation. And combinations, mergers, when two not-for-profits come together. Optional fund accounting. Not-for-profits may use fund accounting for internal purposes to facilitate reporting back to grantors. And let me explain this to you quickly here. And why do you think, once again, why do you think we would want to use fund type of accounting in not-for-profits? Once again, why? All right, let me give you a little hint, and then maybe you can tell me why you think in practice that might not be a bad idea. See these ones here? These are the different funds. And when you have different funds, what is it amenable to? Bless you. To fund accounting. They even have agency funds, endowment funds, loan fund, restricted, unrestricted. Each of these funds is self-contained, has its own assets and its own liabilities. And that's why fund accounting. So you can see that. So all of these assets minus liability would be equal to net asset or some fund balance except for one. Which one doesn't have the agency, right? Yeah. All right, so as a review, what do we want to learn out of this chapter? First, know what a not-for-profit is. I think most of you do know what its purpose is. How is it different from a governmental not-for-profit? Whose rules do you apply? Whose GAAP do you apply to the not-profit? GASB or FASB? Okay. So then, after you've figured that out, you need to know what statements are required of not-for-profit. There were 3 statements plus 1 statement required of voluntary health and welfare organizations, right? There was 1 statement required, which was a statement of functional expense. Understand the format of the statement. What do I mean by format? Remember those 3 columns or 3 categories? Know the meaning of those 3, okay? What they are, all right? You know, the unrestricted, temporarily restricted, and permanently restricted. Once you've got that figured out, now comes the accounting stuff. How do you recognize revenues? And you might say, revenues, what do you mean? Do you mean like selling items in the gift store, or do you mean somebody writing a check? One is what? Contribution revenue. The other one is just revenue. One is non-exchange. One is exchange. We concentrate on what? Non-exchange, because that's the largest portion of it, right? Once you've figured out, then you figure out how many ways can you get a contribution. Well, you could have somebody write a check, immediate contribution, or somebody say, I will promise to give you some money in the future, which is called what? A pledge. Sometimes you'll get a pledge which has no conditions attached. You can recognize it right away. Sometimes the pledge comes with conditions. Not till next year or 3 years from now, or not till you've met this condition. Recognize it when those conditions are met. That's the revenue side. Now let's go to the expense side. Apparently we need to separate the costs associated with programming or whatever that charity's mission is from support expenses. That's why we have the statement of functional expense, right? So we have those two categories. What do? We take all our expenses and allocate them into those two categories, right? Why? Because we want to, in the next class we'll discuss how we measure how effective the charity is. Okay. So once you've done that, now think about expenses. Well, there are salaries and all that, but one of the important items that occurs with charities is volunteer work, right? When volunteer work is received by a charity, it can come two ways. One is just plain work, which doesn't require any specialized skill. You debit what? An asset account. You might, you debit an expense account and you credit a contribution account, okay? Or you could have what? Somewhere which requires specialized skill. If it's a specialized skill, what do? You debit the asset account and you credit the revenue account of some sort, okay? So that's how the next stuff all deals with how do you show assets. If you don't remember anything, assets are mostly shown because they have financial assets. They're shown at what? At their fair market value. They're always shown at their fair market value, whatever is given to them. And that's why, this is not a time for this discussion, but you should think about, why do you think people who have a lot of money and have lots of stocks, instead of giving money to a charity, want to give stock? Because what is their tax deduction based on? On the value of the securities they have contributed. Now you might say, but what does that mean? They're avoiding what? The capital gains. Look, they could have sold those securities, taken the money, and given it to the charity, right? But then what would have happened? You would have had to pay capital gains tax. So what do? They just move that over to the charity, because when the charity sells those investments, do they pay taxes? No. So do you see how, and this is how, this is how this is done in practice. And this is just a small example. I mean, think about people like Berkshire Hathaway with the Gates Foundation, where he decided that he was going to give all his wealth to the Gates Foundation. I'm not sure how his kids felt, but he said they have enough money. So he's done that. Why? To escape the estate taxes that could be levied. Because you basically transfer the ownership effectively to the charity itself. So these are some of the, again, this is not a subject that I am in any way an expert on, but these are the things that come to mind when we talk about assets. Liabilities, there's nothing special, but in terms of net assets, we needed to remember the three categories, and finally the use of fund accounting.